Hi everyone, good evening. You're watching The Money Show on ET Now with me, Mubina Kapasi. This is a show where we get you your latest scoops and updates with respect to news that affects your personal finances and money matters. Well, as always, we will be talking about an aspect of personal finance that all of you must know, and that's with respect to the availability of credit facilities. COVID-19 is something that's obviously casted a lot of uncertainty on our future income earning ability. A lot of us, in fact, have been facing even cash flow mismatches because of which perhaps we've not been able to make timely payments of certain obligations, maybe rent, maybe interest, or it could be any other expense that you had to pay out. However, there have been various credit facilities that banks have been giving out. In fact, some banks, especially the PSU banks like a Bank of India, Bank of Maharashtra, have been offering something called as a COVID loan, which has very special terms and conditions. It's usually offered to the existing customers of the bank. Interest rates are perhaps as much as personal loan rates. So what exactly are these COVID loans and how do they differ from a regular personal loan? And also, of course, on that very contentious moratorium bit, how should you essentially manage your loans? Another interesting concept: loans against a credit card. Is that really advisable to do? So we'll be talking about all of this and more with Mr. Mayank Kachhwaha of India Lens. He joins us right here on the show. India Lens is, of course, a digital lending platform. Thank you so much, Mayank, for joining us today on the Money Show. Let's start off first by, talking about this problem that a lot of individuals will be facing, and that is with respect to a cash flow mismatch. In fact, I'm going to extend it not just to individuals, but also to any small-time entrepreneur who may be watching today. The entrepreneur has payments to make. He has bills to pay. He has employees to pay. Unfortunately, income may stop, but expenses don't stop. To meet those cash flow mismatches, what sort of facilities are available today with banks, with financial institutions that can help individuals and small business owners tide over this crisis?
So what happened when the lockdown started was that the majority of the lenders were actually meeting the person to do KYC. And so ever since the lockdown's been on, a lot of the lending actually stopped in the beginning, right? And since then, some of the large banks and some non-banking finance companies have come out with specific products. Right now, most of these products are available for retail borrowers. Obviously, with all of the government schemes coming in, a lot of the focus is now moving to MSME lending as well. And some of those schemes are still being figured out with the non-banking finance companies and banks. But retail loans are still, to some extent, and not to the extent that they were available before COVID crisis hit, they're still available to a lot of people. I mean, while we're looking at it, a lot of the banks have started this specific type of loan called a COVID loan, where interest rates are usually slightly lesser than a typical personal loan. But given the constraints within the bank and their ability to originate new loans with new customers, they are largely focusing on existing customers and offering them these loans. What is also possible is there are certain institutions, especially on platforms like ours, where we are able to extend lines of credit to individuals, right? And these are obviously done post checks that are being done. So the line of credit, I think, usually a very flexible product, and it's sort of a pay-as-you-use product. Very different from a typical term loan, where what happens with the term loan is that you have to start paying EMIs right up front because you've taken all of the money up front. But in a line of credit, it is essentially a facility where you can choose to have it approved and use it when you need it. It gives you the flexibility, and the interest rates on these products are typically also in the personal loan range. So they're not very far off from what you would get with a personal loan. So I think with these few products, some customers can actually solve their liquidity problems by availing some of these facilities.
Okay, the fact that they are short-term loans and that they're just to essentially help you tide over that liquidity. If you could just share some light on what's the sort of interest rates they carry, and also what sort of customer are they for? I mean, do you need to have a particular credit score to be able to avail these loans that will help you bridge that gap?
So again, I think bank criteria, lending criteria still applies, right? So they're not available for everyone, and so there could be a variety of things that are being used in the back end, right, from credit scores to information about the information that comes from bank statements like salary credits and whatnot. So there is a lot of checks that I think the banks have in place to ensure that they're only underwriting good credit customers. But and also I think the good part about these loans, the COVID loans especially, is that the interest rates are actually quite attractive, right? I think given that they are intended for the customers to sort of benefit from them, I think they are very good right now if you're sort of looking for and you need some money to tide over things, especially if you have cash flow crunch. Then I think some of these loans are or the loan interest rates are quite enticing.
Okay, all right. How do they, if you could just still, clarify for our viewers, you mentioned flexibility as one of the terms in your first answer, but exactly how do they differ from just taking a personal loan, a regular personal loan?
So specific to a line of credit, what happens with the line of credit is that you sort of get approved for a line, right? Much like let's say a credit card, but credit card is a revolving credit facility and credit line products are not. So what happens with the line of credit product is essentially you have a line approved, let's say for about 1 lakh rupees that you don't have to withdraw right away, right? You can choose to withdraw it as and when you want, and that particular withdrawal will convert into an EMI or will convert into a bunch of EMIs for a particular tenure that you can choose. Right. So what happens with these is that if I have a line approved for let's say 5 lakh rupees and I currently only need 1 lakh rupees, I withdraw only 1 lakh rupees. Therefore, the EMIs and the interest that I'm paying on these on the credit line is actually only for the 1 lakh rupees, and it starts when you withdraw as opposed to when the line gets approved. So this gives the user a lot of flexibility in being able to use it when they really want it, but also gives them this comfort that they have an approval already and they don't have to go through an entire process of applying and giving documents and all of those things when they really need the money, right? So it's an instant facility if you're already approved for it, which benefits the customer in many ways.
Okay, makes sense. But I think again, preference would be given to the existing customers of the bank for a facility like this for obvious reasons. I mean, the KYC has already been done. They already know who the customer is, what the payment profile, the credit profile is. So I suppose the bank who you're currently banking with, it's best to essentially go to that bank and talk to them about what sort of credit facilities are available. Okay. What about these loans against credit cards, now that too is a new option, and I know for a fact that any delay in credit card payment will attract an extremely high penalty. We are talking about almost 41%. When it comes to a credit card, a loan against a credit card, do you think that would be an option as well that people could consider, or the loans that we were talking about earlier, the COVID loans, etc., that in itself I think is something that customers, businessmen, individuals should opt for?
Yeah, I think credit cards, like you mentioned, right? The interest rates on credit cards are pretty high if you're just making minimum payments. So if your intention is to borrow or use credit using a credit card, the preference should always be to go toward lower interest loans, right? From COVID loans to personal loans to let's say lines of credit. Credit card very useful in two categories, right? One, if you're not eligible for either of those and you already have a credit card, and therefore you have credit available on your credit card. The second aspect of this is actually the fact that credit card, because it's already available with you, you don't need to go through the process again of having to apply and seeing if you're eligible. So it's an instant facility available to you. So only when you really need money on a credit card or really need money right now is when you actually opt for a credit card loan. And when I mean a credit card loan, I'm primarily meaning revolving balance on your credit card as opposed to trying to get a personal loan.
Okay, understood. So that's essentially when it comes to making credit card, or rather taking loans against credit cards. Okay, you know what? I'm going to also remind our viewers that if you would like, you can email us any questions or queries that you may be having about obtaining credit facilities or how to manage your loans, and Mr. Mayank Kachhwaha can get that answered. But talking about loans now, Mayank, we've spoken so much about this, and a lot of our viewers as well have been asking that should they opt for the moratorium, because there have been some very scary terms and conditions that some of the banks are putting forward if individuals do want to opt for the moratorium. So what's what are some of the factors that you recommend borrowers should consider before they decide whether or not the moratorium should be taken?
See, I think the first thing here is that if you have the money, recommendation is to make EMI payments. Because the most important clause in this moratorium, right, is the fact that I think interest is still getting accrued through the period of the moratorium. Now, what that really means is that if I was to take an example, right, let's say you're running a home loan of 50 lakh rupees and it is for 20 years. And let's assume you made 12 EMIs or you paid 12 EMIs. And so you have about, let's say, 19 years of payments left. So all of the principal that is left right now on those 19 years, interest is going to be calculated for the 3 months on that. And so what happens because of that is that if you were to, let's say, over the term of the loan, make 100 rupees as payment on interest, the overall payment that you would make over the 20 years, if you opted for moratorium, would be much higher. It would actually be much higher if you are early in your tenure in your loan and lower if you're later in your tenure in your loan. So I think the first thing that one needs to understand and evaluate is, do I have cash right now to be able to make EMI payments? If yes, I think in almost all cases, I would recommend that you actually go and do that. If you don't have that option and if you obviously have a liquidity crunch, then I think if you are opting for moratorium, please understand that there are going to be extra charges from the interest accruing in the 3 months through the moratorium, and therefore you are going to be liable to pay more than otherwise if you didn't opt for the moratorium.
Okay, that's the recommendation then coming in from Mr. Mayank Kachhwaha. Okay, let's take on board some questions then that we've received. First up, we have Sridharan Arukavil, who has written to us saying, my son has been paying back his home loan EMI. Interest is based on MCLR. Please advise whether he will stand to gain if he switches over to the repo-based interest regime. Repo, great product, a very interesting one, launched in October 2019, wherein the interest now will be dependent on what the RBI announces, which will be roughly once in every 2.5 months. Mayank, given the entire environment that we are in the midst of, given coronavirus, do you think that a repo-based regime would be a good option to choose right now?
So I think most experts recommend it right now. I think it possibly might be a good idea to move to a repo-based or repo-linked rate. I think over the long term, though, I think you'll have to understand, because these rates move about. I think you need to also take into account the fact that over a period of time, these payments could also go up. So I think this decision has to be taken taking into account your current cash position. And if you're actually looking to get only a short-term benefit, and maybe you can decide to move in that direction. But I think you'll have to carefully calculate exactly what the implications are. It's not a very simple answer, straightforward answer. It really depends on your current situation and how these interest rates move, I think, in the short term and the longer term.
Okay, all right. So that's essentially what the recommendation is when it comes to, how you should go about when it comes to managing your loan, whether it's MCLR or repo. Yes, repo could go down, but it's a case-to-case basis. Talk to your bank and also consider what the switchover charges, if any, could be. Okay, Madhav Kumar LR has written, can you please clarify the below statement that many banks are putting in their loan moratorium FAQ? Interest shall continue to accrue on the outstanding portion of the term loans during the moratorium period. I think, Mayank, it's something that you did speak about when we, discussed whether or not to take the moratorium. But still, for the benefit of Madhav, if you could just reiterate, what exactly does this sentence mean?
So I guess use the same example again, right? What if let's say I'm taking this example, right? Let's say you're running a 50 lakh rupee loan, home loan, and it goes on for 20 years. And let's say you make 12 EMI payments. In the 12 EMI payments, essentially the principal still remaining is close to about 49 lakh rupees, right? And so on that 49 lakh rupees, for the next 3 months, interest is still going to be calculated. In simple terms, what that really means is that the interest for the next 3 months on the 49 lakh rupees is now incremental to your existing loan obligation, right? So if you were, let's say, making payments and over a lifetime you would have made a payment of 100 rupees, for instance, you would end up making a payment of more than 100 rupees if you do opt for the moratorium. Now, I think the nuance that I was talking about earlier is it really depends on if the number is 101 or let's say 110 on where you are in the tenure of the loan. Because what happens with all of these loans is interest gets paid first, and so in the beginning, a lot of in the early EMI period, a lot of the principal is still left, and so you end up paying very high interest amount on a large principal left. But if you've seen a lot of the tenure already of the loan, then you have a smaller amount of principal left, and so the interest is going to be calculated on that smaller principal left, and therefore you might actually end up paying lesser than if you are early in your loan. So I think these are the things that to take into consideration while sort of deciding, like I said again, for opting for moratorium or not. But in all cases, if you have the money, I think the recommendation would be that do not opt for the moratorium and continue to make payments, because in the long run it is a bigger hit.
I cannot stress more on the importance of the fact that if you do have the money, there's no reason why you should just simply pay off your loan. If you're okay on your cash flow position, it's always better to not opt for the moratorium. All right, Mayank, thank you so much for joining us today then on the Money Show, and sort of just advising all of our viewers about what are the options available out there if in case you are facing that cash flow crunch, or you need that little bit of money to bridge the gap between what you need right now versus what your expected and potential payments are expected to be. Thanks so much for joining in.